Hi. So last week I was talking about Minsky and the financial instability hypothesis, where it came from, and the basic sort of dialectical foundation that Minsky had of talking about stability being destabilised. This week I want to talk about endogenous money, because an essential part of explaining how finance can have a deterministic role in economics comes out of explaining the creation of money and how that creates demand and income. So I've got to go through all the logic of that. And it's a long path because this is still an area which is in dispute amongst post-Keynesian economics. I have all sorts of fights with my fellows on that front, still having them. I reckon I'm right, and I've got to convince you guys as well, but we'll see how we go. I'll talk about both perspectives as I go through. But I want to go back through the history of how this view about the essential role of finance and economics has waxed and waned in economics. If you go back and you read people like Schumpeter, then you find expressions like this, where he's talking about the role that the banking sector has in creating additional demand for entrepreneurs. And when he's talking about how banks provide money to entrepreneurs, he then says it's a question not of transforming purchasing power that already exists in somebody's possession, but of creating new purchasing power out of nothing, which is added to existing circulation. So it's not just the money being created, it's also seen as being additional demand, which is where entrepreneurs have the capability of demanding goods, even though they haven't actually produced any to sell themselves yet. And Minsky, one of the key phrases that I work from in Minsky, is this particular expression, which is the natural starting place, and it's really the section that I've bolded that I want to emphasise, for analysing relation between debt and income. So he accepts there is a relationship, proving that it just is another story as well. And that's the starting point of his cyclical model of the economy. So what is that relationship? Let's see if we can find out. Now, macroeconomics, on the other hand, the mainstream macro, leaves banks, debt and money out of capitalism completely. I had an interesting exchange with Tony Yates, who's one of the more rabid neoclassicals in this country. And I made a comment about how you can't find them at all in... banks, debt, money don't exist in mainstream economics, and he wrote a rubbish search and you'll find dozens of papers. Well, the first one I found was a definition of banks, debt and money, and the next three were my papers. So I laughed about that particular one. And what he called papers with debt, banks and money in them, I thought basically had at best one of the above three in any particular sense. The definitions of banks were just jokes. But when you look at people like Krugman, I still find this a remarkable statement. I'm all for including the banking sector in stories where it's relevant, but why is it so crucial with a story about debt and leverage? Yeah, I know. I just got to laugh at some of this stuff and think, you've got to be kidding. But that's the guy who's probably the main defender of the neoclassical faith about the non-role of banks and debt and money and capitalism, except during what he calls the liquidity trap. So he's the main one that I focus on when I talk about the definition of loanable funds. Now you can also say, in some sense, that Keynes contributed to that, because if you read the preface to the General Theory, he says at one stage that technical details about money go into the background. So he's talking about the treatise of money, and he's saying he's still looking at the role influence of money as something, so to speak, separate from the general theory of supply and demand. I think he still intellectually saw himself as a Marshallian, extending Marshall, and what he saw as his role was to integrate that with the general theory of supply and demand. So in some sense he was trying to generate a supply and demand theory of money. And he was finishing the treatise of money. He thought he was actually making the monetary theory something the theory of output as a whole, which meant having a supply and demand explanation of monetary theory. But he then said he hadn't dealt properly with the effective changes in the level of output. And finally talks about, again, the equations in the treatise of money, an instantaneous picture on the assumption of a given output and how they could force profit disequilibrium and then force a change. But the dynamic development was incomplete and confused. And he says this book has evolved into primarily a story of the forces which determine the changes in the scale of output and employment as a whole. And here's, I think, the crunch about just how little a role banks, debt and money had in the general theory. Whilst it is found that money enters in an essential and peculiar manner, technical monetary details fall into the background. Now, Vicky Chick does a lot of work on the history of the evolution of Keynes's views, and she knows much more about this than I do, and so does Jeff Tilley. So if I want to recommend some readings, I'd recommend looking at work by Vicky Chick or Jeff Tilley on how the general theory actually evolved. Pardon me, I'm actually changing my hearing aids here. I'm getting a lot of echo in the sound I'm hearing here. And so they make other cases. The case that I remember Vicky making, and also to some extent Jeff, is that the treatise on money was written at a time when you still had all the financial chaos and the early onset of the Depression. And that was Keynes, in some ways, when he wrote the general theory, thought most of that stuff over the nature of banks was resolved. So he wrote the book leaving that as in the background, no longer an essential part of the story. Whatever the logic for not including them in there was, I think it's one of the weaknesses of the general theory that you don't find much about the role of banking inside there. What you do find is the argument about a monetary economy being one in which views about the future can influence the quantity of employment today and not merely how it's allocated between different sectors. So expectations and uncertainty became how Keynes talked about money in the general theory, rather than talking about the role of banks as a particular engine of creating demand and creating money. And you notice he says here, a method of analysing the behaviour of the present under the influence of changing ideas about the future is one in which depends on the interaction of supply and demand. So he was still and had a Marshallian mindset, and his idea of a general theory was to integrate everything into a supply and demand picture. And this partly justifies the attitude that Paul Davidson takes to Keynes. Takes to Keynes, where he really is what they're going to love me for the cleaners, aren't they? Where he talks about seeing Keynes in a Marshallian guise. So you do find a strong Marshallian flavour to what Keynes was writing, and he then sort of led to a more general theory, which includes the classical theory as a special case. Now, as well as saying that's the classical, neoclassical theory, as we call it today, where you ignore change. You presume you could talk about an equilibrium now without considering the future. It's also, and to some extent, pushing banking into a supply and demand framework. And of course, a large part of the endogenous money case is that you can't do that. So I don't think it's amazing if people saw Keynes as a major pivot, and the general theory as the book on which his work pivoted, that the whole issue of how banks fit into the economy declined after the general theory. I think Keynes actually played a role in that. Now, post-Keynesians, on the other hand, argue that a monetary economy is fundamentally different from a barter economy. And when you think about supply and demand, that really is an analysis without money in it. That's really a barter-type foundation. So what you see with Keynes is this argument about money as something which is related to our uncertainty about the future. So here is Keynes being satirical about how money is treated in conventional theory. And this is the 1937 papers, which I think I've always argued to my students, if you want to understand Keynes, read the general theory as a historical text, read the 1937 papers as a better exposition of how Keynes was thinking. Because I think the general theory has this mishmash of Marshallian material and stuff that's actually quite non-Marshallian. When you get to 1937, the non-Marshallian stuff is really taking over in Keynes's mind, and I think it's much, much clearer material. It's also much shorter material, much easier to understand too. So here he's being satirical about the way the classical theory treats money, that they have to accept that money exists, but it plays no role in neoclassical theory. And he says, so money has two principles: by serving as a unit account, it facilitates exchanges, so in that sense it makes barter easier. And then he said, in the second place, it's a store of wealth. Now then he starts getting satirical and says, so we're told without a smile on the face. But in the world of the classical economy, what an insane use to which to put it. Because again, from Keynes's point of view, the classical theory had no sense of uncertainty about the future, no idea about the role of the future at all. And therefore, why would you hold money if it didn't give you any utility? He says it's recognised characteristics of money as a store of wealth at its barren, whereas practically every other form of storing wealth yields some interest or profit. So why would you have money as an asset that yields no income stream versus holding one that yields an income stream? Why do you hang on to it? He says, why should anybody outside a lunatic asylum wish to use money as a store of wealth? And here's a wonderful, I think one of the cases where Keynes's language and logic are just superb, because partly on reasonable and partly on instinctive grounds, the desire to hold money as a store of wealth is a barometer of the degree of our distrust of our own calculations and conventions concerning the future. And one thing I haven't read in Keynes, which I must read, is Treatise on Probability, because he argues that there's this distinction between the views we form and how confident we are about those views. And that turns up in this particular phrase. So the possession of money lulls our disquietude. The premium which requires to part with our money is the measure of the degree of our disquietude. So the money, we hold money proportional to our distrust of our own expectations about the future. Okay? So I think it's a very strong insight, but at the same time it's linking money's role into the question of uncertainty rather than to the technical process by which money is created today. So I think this is a major part of why you saw that divergence between the neoclassical interpretation of Keynes, which ignored all the stuff about uncertainty, and the post-Keynesians, which focused upon uncertainty, but they still had the technical issues of how money is created in the background. And the start of bringing the technical details back into the foreground again was the whole concept of endogenous money. And that's a common theme in many of the precursors to Minsky. So that the banks create money, and that there's a role for credit and aggregate demand. You can find that throughout the people on whom Minsky based his own theories. So Fisher is one of the classics on that front, and Fisher, of course, was a neoclassical, the leading mathematical economist of his time, and of course lost a fortune during the Great Depression, was financially wiped out and intellectually shocked as well, and then in a really interesting procession of papers between 1929 and 1932 began to overturn the logic he'd used previously. But an essential part of his thinking, again, was the role of new money being created by the banking system. And it says new money is created not by the MID or the Bureau of Engraving, but by the pen and ink of the banker and his customer. And then when the customer pays his note, he undoes the whole transaction. When somebody repays a debt, in other words, he wipes out an equal amount of circulating credit. And therefore he's making a strong distinction between loans between individuals who are not banks and loans issued by a bank. Because the payment of a business debt owing to a commercial bank has very different consequences of paying a debt from one individual to another. And the lack of understanding of this is what the neoclassicals have carried forward today. So he says a man-to-man debt is 1930s language, no sense of having to be politically correct. So a man-to-man debt may be paid without affecting the volume of outstanding currency. If whatever is paid by one is received by the other and is still outstanding. So there's no elimination of money, and therefore no elimination of a potential source of demand by paying off a debt between one non-bank agent and another. But when a debt to a commercial bank is paid by cheque out of deposit balance, that amount of deposit currency simply disappears. So you have a cancellation of money by the process of repaying a debt. Schumpeter, in the Theory of Economic Development, which, as I said, I highly recommend everybody here reading, when he's talking about the way in which entrepreneurs get funding, he said an entrepreneur is somebody with a good idea but no money and no goods that they're currently producing. He abstracts from the existence of entrepreneurs who are inside existing firms. Now he's looking at somebody who's got a great idea but no money existing to put that idea into operation and no goods they're selling that they can sell to finance putting the idea into action. So they have to approach a bank for a loan. He says when they approach a bank for a loan, what the bank does doesn't transform existing purchasing power, it's the creation of new purchasing power out of nothing. Even if the credit contract is supported by securities. So he said even if you do have collateral as part of the loan contract, fundamentally that's there as a backstop for the bank. It's not created given the existence of the collateral. It's the bank's decision to lend the money that creates the money and creates additional demand for the entrepreneur. And he says this is the source from which new combinations, new technology are often financed. And here he's allowing that, yes, you can have people who are entrepreneurs investing with money they already have. I'm going to turn the lights off to make it easy to see. What is that? He's saying that when an entrepreneur gets funding from a bank, that actually is creating money and creating demand that the entrepreneur can then put into action. So he said purchasing power is created in the first case, to which in the first case no new goods correspond. So you've got the capacity to demand goods with no selling of goods yourself to do that. So there's an endogenous creation of both money and additional demand that is then expressed by the entrepreneur when they buy the goods and services they need to turn their idea into a product. And then this is, I've actually, the translator of this, if you read the preface by the translator, says there's some expressions which are hard for him to translate in German. We talked about whether Marx used incommensurable, and sure enough he did, according to Severin in the German edition, that whole thing about talking about incommensurability in last week's lecture. But here, total credit was a different phrase that Schumpeter used, and that's the best translation that the translator could come up with. So it does look confusing, but it may be the translation that made it that way rather than Schumpeter's original words. So he's saying for that, it follows, therefore, that in real life, total credit, total demand in that sense, must be greater than it could come if there's only fully covered credit, meaning demand generated from existing goods, from the sale of existing goods. So there's some demand coming to the economy which exceeds that which is generated by selling output. Now, that's all ignored by the neoclassical mainstream, which went effectively what Fisher called man-to-man debts. They made their model of how lending actually is, this idea of loanable funds, where banks are just intermediaries between savers and investors. And the last couple of years, in trying to defend this position intellectually, Krugman pointed to this particular paper by Tobin and saw that as being the thing that just completely trashed the entire idea that you should worry about banks in economics. He argued that whole thing about why are they so important. This is his basic argument. And this is a paper from Tobin in 1963. And he talks about what he calls the old view. And what he's got in there, that the opening of it is talking about the money multiplier story. How the banks can create money using the money multiplier. And that's his picture of how banks create money. But he calls that the old view. And what he sees as the new view is that banks are just intermediaries between savers and investors. He says the essential function of financial intermediaries, including banks, is to satisfy the portfolio preferences of two types of individuals. One side is borrowers who want to expand the holding of real assets beyond the limits of their own net worth, so want to borrow money so that they can buy something they couldn't otherwise buy. But on the other side are lenders who want to hold part of their net worth in assets of stable money value with negligible risk of default. So this is the idea of banks linking together borrowers and savers, or investors and savers. And he dismisses the argument that banks can create money out of nothing. So he said neither individually nor collectively do commercial banks possess a widow's cruse, something which can produce indefinitely. And he said they're limited in scale by the same kinds of processes that determine the aggregate side of other intermediaries. And he's down again to another supply and demand argument. It's just the supply of money by savers, the demand for money by investors, and completely rejects the idea that banks have a special status or the capacity to create money. He says the distinction between, this is his overall summary of his paper, the distinction between commercial banks and other intermediaries have been too sharply drawn. They're of degree, not of kind. It's little to do with the monetary nature of bank liabilities, so you can forget about bank deposits. They're related to reserve requirements and interest ceilings, but if you impose the same thing on other types of financial intermediaries, they behave the same way as banks. And they don't, again, he comes back and pushes this argument. This is a second quote talking about the widow's cruse. Does anybody don't know what the widow's cruse means? Okay, it's a 19th century type expression, but it talks about a widow who can continue pulling money out of something indefinitely. There's a never-ending source of like a magic pudding from which you can continue eating, and the pudding never gets any smaller. So and Keynes used that argument of the widow's cruse at various points in the general theory. Yeah.
I mean, what they're talking about here is a matter of fact, right? How banks operate is a matter of fact.
Yep.
It's not a matter of economic theory.
Exactly.
It seems very odd that somebody could write a paper like that. And I mean, you must have never talked to a banker, right?
I know. It is ridiculous. But this becomes how bankers themselves get educated, and if they're not bright enough to realise they're being conned, they swallow this stuff. And certainly, if you read what Bernanke has to write at various times, he also, the academic neoclassicals fall for this whole idea that banks play no particular role, which they couldn't, if they'd actually talked to a banker or saw how banks actually operate, they could never argue that way. crazy. I mean, I meet a lot of bankers. I meet some bankers who've got what I call a bottom-up perspective, and they are totally involved in the whole loans engine inside banks and think they've got to borrow the money before they can lend it. They don't look at the aggregate side of the entire banking system or even what they do on their own bank ledgers. Other bankers are quite happy to say, look, I've created money. I've given a loan to somebody, I've written a loan in the column, I've written a deposit in the deposit account, I know I've created money at that point. So Michael Kumoff, who works for the Bank of England and is a strict neoclassical DSGE modeller, worked as a banker before he became an academic, and he said he knows he's done that. He's an absolutely crucial role that he's got in creating money by creating a loan. So there's a practicality to this which is beyond theory. But they have a theory that basically says that practicality doesn't exist. It is strange. So again, he's just saying, again, you can forget about banks apart from, that's not repeating the same slide, I must have run backwards by accident. So what you've got by this loanable funds view coming dominant is the people who argue that banks matter go from being in the centre of the profession, as Schumpeter and Fisher were at their time, or certainly, well, there was a general belief in that. It wasn't an unusual thing to accept that banks create money before the 1930s. But after the 1940s and 50s, when particularly American neoclassicals became dominant in the profession, the view that money was created by banks and that had any special significance in economics became a fringe view. And the original champion of its revival was Basil Moore. Anybody read any work by Basil yet? Good. Worth reading a lot more. Good guy. But this is probably the key paper he wrote was one called The Endogenous Money Stock, back in the Journal of Post-Keynesian Economics back in 1979. He's Canadian by birth, did most of his economics in the United States, and he now lives in South Africa. And what he did, and a large part of what he was trying to do is reverse the causation that's implied by the money multiplier model. So if you look at the money multiplier model, it argues that the money base comes first, multiplied by the reserve ratio will give you the amount of money in existence. And that argues that if you control the money base and you control the ratio that exists between the money base and your allowed level of loans, then you can control how much lending is generated by the private banks. So even though you think they're creating money via the money multiplier process, because those two levels, the level of base money is controlled by the central bank and the reserve ratio is set by the central bank, that means the central bank controls the amount of money in existence. He had to reverse that. He had to go against that. And when you look at Tobin as well, Tobin assumes that when you talk about money creation, you're talking about the money multiplier process. You're all familiar with the money multiplier process to some extent? Okay, I talk about it rather than explaining the logic of it, such as it is, in this lecture. I might actually show why it's totally institutionally wrong in the next lecture, so I'll use Minsky for that. But what Basil argued, it worked in reverse. So the amount of money that was created by the banks determined how much reserves were created, and the central bank simply accommodated the demands that the banks had for liquidity. And the main mechanism he was looking at, which really no longer exists these days, is a line of credit. There are some, but they were much more dominant back in the 1960s and 70s. And a line of credit was like a large credit card, fundamentally. A firm would negotiate a line of credit, meaning it had the right to borrow up to a certain amount of money, would often be syndicated amongst a range of banks. You might imagine a firm like Ford, for example, might have negotiated a line of credit of, say, $1 billion US, which was the right to draw up to $1 billion without having to go back to the bank to do it. So they've only access to $100 million worth. They could draw up to $900 million without needing to go and do any negotiation with the bank, which is like your credit cards. If you have a credit card right now, you've got an amount of money you've actually got active on it, and you have a ceiling, and you can just simply go and use that money up to the ceiling without having to go and ask the bank's permission. That's what a line of credit is like. These days, corporations use commercial paper because the banks made lines of credit too expensive for them. So the whole idea of them, though, was that if you have rapid changes in your cost of inputs, you can simply access the money you need to pay for them from the corporate's point of view. You don't have to go and borrow money if there's a sudden change in your cost structure. And Basil argued that reverses the causal process that's argued in the quantity theory of money. So if you look at the quantity theory of money and how Friedman uses that, he argues that changes in money cause changes in the price level. Now, what is argued by Basel here is the changes in the price in the price level, things like wages, cause change in the money supply, reverses the causation. And just to take you through the logic there, or his arguments there, he says, changes in wages and employment largely determine the demand for bank loans. You could, of course, after the 1970s, you could also add changes in the cost of raw materials, like when the price of oil was quadrupled by OPEC in 1970, was it 1974, 73, 74? The first time they did that, instantly you had to pay 4 times as much for your oil one day after OPEC made that decision. So you had to have the capacity to suddenly pay a lot more money, and therefore the change in the prices of oil meant you then accessed your line of credit, and by accessing your line of credit you created additional money. So that's the reverse of the causation in the money multiplier model. He says central banks have no alternative but to accept this course of events. All they can do is vary the short-term interest rate, which they supply liquidity like that. But if the banks demand extra money, if the firms demand extra money and have the capability to create that money by accessing a line of credit, and that then changes the ratio between the amount of money the banks actually have and their reserves, and therefore the banks need extra reserves, then the central bank simply has to provide those reserves. That's the argument there, and there's much more institutional detail about that coming up as well. So commercial banks can supply whatever volume of credit the economy that borrowers demand. So totally elastic. And the way he put this across was to talk about the money supply being horizontal. And I think this led to a huge debate in post-Keynesian economics. I think it was fairly pointless because the argument was, well, what's the slope of the line, etc., etc. Is it horizontal? Is it slightly sloping up? Is it sloped down, etc., etc.? The line itself is an abstraction. It's a way of trying to represent what's going on, but trying to represent this stuff in drawings, static drawings, is just not going to work. So I think a lot of this debate also was pointless. Yeah.
Because he's referring to the arguments taking place in the context of the ISLM model.
Exactly. That's where it makes sense, because the ISLM model draws a vertical line for the money supply, and the reason it's a vertical line is it's not determined by the market system. So the idea of the ISLM model is that the central bank can simply move the amount of money by moving that vertical line one way or the other, creating additional demand. And then what Basel is saying here is effectively, if anything, the money supply is horizontal, not vertical. Okay. So rather than being totally vertical, what you're saying is the money supply is completely exogenous to the economy. It's controlled by the central bank. By saying it's horizontal, what Basel's arguing is completely endogenous. But that was then interpreted within the post-Keynesian literature as meaning, well, the amount is determined by the borrowers. The banks have no role. If it's horizontal, the banks themselves have no control. And partly the argument came back, well, the banks do have control. They do have credit rationing, etc., etc. But I think you're better off to think of it in terms of how Basel saw it, which was this debate between ISLM and the real world, where that is so unrealistic, this is a lot more realistic, but neither of them describe the actual process properly. So the fundamental point of the endogenous money case is that the supply of money was determined by the demand for it. There's no independent supply curve. And again, we come back to Keynes trying to build, in the general theory, thinking he was building or integrating money into the supply and demand framework, when part of the endogenous money case is to say, well, there is no independent supply curve in that sense. Now, there may be a dependent supply curve or a dependent supply function. Not there's no supply function. Okay. But not independent completely, as it's argued in conventional theory, and not exogenous as the ISLM argument made it. So he's saying all the state can do is affect what the price is paid, and again, this is thinking in terms of that flat line. If you think in the strict ISLM model, then you've got a vertical line that says that the state determines the amount of money, and then the demand curve, which can move in or out, will determine the price of money. In that sense, that the ISLM model says the market sets the price of money, the government sets the quantity. Now, what's being argued by Basel here is when you go and say, well, it's closer to being, if you want to use a diagram to represent it, it's closer to having a horizontal line, then the government can set the height of the horizontal line, which changes the interest rate, but not the quantity. So it's reversing that perspective as well. But still, I think not getting to a full institutional appreciation of the role of money. Yeah.
I mean, as far as you know, did central banks ever control the money supply?
I'd argue never. And the best argument for why they don't control the supply of money is that what they have got control over is the amount of reserves. Okay, they can control the amount of reserves, but that's state-created money. What they can't do is control the amount of reserves at the same time, because if they do, then they can void transactions between people who've actually got sufficient money in their bank accounts. Because if you at least think about, I'll come to your question in a sec, but if you think about if you go shopping, and you're going shopping and you happen to bank at the HSBC, let's say, and you've got 100,000, if you want to go and buy a new Tesla, you're quite wealthy, you've got a couple of £100,000 in your account, and you go to make the purchase, and it happens the Tesla dealer banks with Lloyds. Now, if HSBC quite possibly could have only £10,000 of reserves, its reserve account is completely independent of your bank account. You've got £200,000 in your account, so you pay your £200,000 for the Tesla. And if the central bank insists that the HSBC had to have the reserves available, then HSBC would be £190,000 short of the reserves it would need to transfer across to Lloyds to put that money in the car seller's account with Lloyds. So if the central bank said, I'm sorry, you haven't got enough money if your bank hasn't got enough money, your transaction would be voided, even though you had enough money in your account to buy the vehicle.
So what you're saying is if they actually strictly held a particular reserve limit,
yeah,
and didn't allow all these things like two windows and all these
yeah,
arrangements, then that would have such severe knock-on effects on the actual transactions in the economy and the way that the economy works.
Yeah.
And so they've never actually been able to do that. Central bankers would realise that you would never be able to do that.
Yeah, I've been told that. I've forgotten who told me. I got a Twitter correspondent saying I think Estonia. I think Estonia had that rule. They required the banks had to have sufficient reserves for all transactions. Now, what that meant was that the banks themselves were always, incredibly. In Estonia, you've got to be extremely careful. If it is indeed true, you've got to make sure you've got massive reserves there, because you never have any real idea just how many transactions are going to occur on a daily basis. So you could do it that way, but it means that if anything goes wrong at any point, then suddenly somebody who knows they've got the money in the account gets this shock. I'm sorry, you can't buy this car, sir, but I've got enough money. Oh, you might, but your bank hasn't. Well, to me that would instantly mean there's going to be a queue at the bank to take money out. So it's a real potential scare, and consequently most of the central banks have therefore gone across to the practical thing of saying that if a bank doesn't have sufficient reserves, you've got 30 days to get them, minimum 30. In some cases 2.5 months. I think the euro system allows 2.5 or 3 months to have the reserves. So rather than reserves being an active control mechanism, they're a passive thing which the central bank enables to expand in the same sense that the central banks allow their deposits to expand. So you have this conventional belief, and actually some, yeah.
I wanted to ask you something related with this investment as well.
Yeah.
What's the interpretation of the demise of the capital controls in the 70s? What I read is this oil crisis created a lot of funds that had to be recycled by the Atlantic banks,
yep.
United States and London.
Yep.
And this implies a loanable theory. What's the interpretation from the Bertinger's perspective?
Well, it's mainly that you suddenly have an enormous amount of money that's in the possession of the OPEC countries, and they didn't have the investment projects to justify having that money. So they would then approach by the commercial banks to say, why don't you leave that money with us and we'll reinvest it out. And you had the opening up of what they called the Eurodollar market. So, and then the Eurodollar market was so gigantic that the capital controls that used to exist were just basically unable to cope, and they're fortunately ultimately eliminated. So in that case, it's the growth of the money supply itself by this huge price change that meant so much money turned up in OPEC hands broke down the attempts to control it using capital controls. So, yeah, but apparently the Eurodollar market really began with the breakdown of it was part of the formation of the Eurodollar market was partly the breakdown of the Bretton Woods system, and the OPEC price rate increase played a huge role in causing that to come about. Yeah.
The Eurodollar market started in the 60s.
Yeah. It was starting, but it grew like crazy after 73. There was a huge increase in the amount of money that OPEC could put into that market. It was already there. I mean, that was what de Gaulle was using to threaten the Americans over the fact that America was running a trade deficit, or pumping American dollars in that sense, paying for goods with American dollars, and promising to any American dollar could be delivered back to Fort Knox, and you get 1 ounce of gold for every $35 you delivered. And ultimately, de Gaulle's the trade surplus France had was such they had so many American dollars that he was threatening to deliver all those dollars to Fort Knox and clean out the Fort Knox gold supply. And that particular pressure was part of what led to the breakdown of the gold standard. First of all, going from $35 in general to $35 for central banks and $42 for ordinary purchases, and then finally breaking down the whole link and having a floating price for gold and breaking the link between the American dollar and gold. Complicated world history.
Sorry, I was wondering about if banks in the end they create money.
Yeah.
They shouldn't even fail. They shouldn't even fail if
They're creating their liabilities, not their assets.
Yeah.
So if
They're creating
it's
both.
your asset, it's not theirs. So they can easily fail.
They can't create an asset for themselves. Okay. If they create an asset for themselves, or they create an asset for themselves, which is the loan, that's also creating a liability for them at the same time. If the person who has that liability to the bank can't repay the debt, then the asset the bank has created gets wiped out. So they can run losses. And it's really, to me, it's really the gearing between the equity the bank has and the cash flow from the assets it owns that matters, rather than the reserve argument. We've got to look at because if you have a huge gearing ratio between your loans and your equity, and if let's say it's a 30-to-1 ratio, well, if 3% of your loans go bad, you've wiped out your equity. So that's really why the banks can fold. And we'll get a good look at that in next week's lecture in particular. Yeah.
When the central bank wasn't the lender of the last was money has money always been a
I would argue it always has been.
always a
Yeah, I mean, if you even look back in the 19th century, there was a period where American private banks could create their own currency. They called them wildcat banks. And quite frequently there would be, I mean, you imagine you know what America's like in general. It's the world capital of capitalism and fraud, and it's often hard to distinguish the two. So a lot of those banks would create themselves in some particular location and make it impossible to redeem their notes by hiding, the actual where they had their treasury in a completely inaccessible location. But banks were creating money, literally creating their own banknotes. So in that sense, the capacity just to create money as a bank has always been there. Central banks are really a clearinghouse between different private banks. And the difference we've got these days is that rather than the private banks being able to create their own notes, these days the central bank does that. Okay, that's the main thing, that it has been centralised. But you have always had clearinghouses of some sort between banks. So there are clearinghouses in New York before there was a central bank. And to me, the fundamental role of the central bank is as a clearinghouse, not something that controls the amount of money in the economy, but actually enables banks to settle their own accounts between themselves, which are caused by the fact that we all bank at different banks. That's the main perspective that I've got on central banks. So, have anybody read David Graeber's Debt the First 5,000 Years? Okay.
I've read it, and he makes this argument that money was always obviously godless, that the first money objects 4,000 years old, and even beyond, the arguing their credit money objects.
Yeah. And the classic to me is in England's case is the tally sticks. You know what tally sticks are? Okay. They're pieces of wood which had marks put on them to indicate debt between two parties, and then they'd be split down the middle, so the debtor would have one part and the lender would have the other. I think the lender's part was called the stock.
The bit you gave out to the person who is receiving it, the creditor gets the stock. Where the stock comes from.
Yeah.
And the stub, so we keep the word stub for tickets.
Yeah.
That's held back by the debtor.
Yeah.
But they were ways initially, they were 10 second using as ways of assessing tax liabilities, and then you could return it early as a discount to get to tax liability. It became the way in which the government raised money ahead of tax collection.
Yeah.
And then the market starts the stocks. As clerks in Westminster move the stock, basically buy stocks at discount, and that's where stock markets arise and holiday trading currencies.
So there's an incredible role that the tally sticks have in the history of England and the development of credit money and so on. And we don't know about them. You know why they don't? We don't have. You can't go to the museum. I imagine
You can. They're various museums.
there are some.
There's
Yeah.
a room in various museums, and
Yeah.
most of them were buried under Threadneedle Street because that's what the bank bought back in 1690 or whatever.
Yeah.
They're buried there, and the rest were, you could pay tax with them until 1853,
Yeah.
and they were taken to Star Chamber and stored there because after 1823 they were no good. They were stored in Star Chamber and they started using them to burn in the fires of Westminster to keep some heating going, and they burnt so fiercely they burnt Westminster down.
One day, which was 1839, wasn't it?
Yeah, so
I think in 1839, Parliament House as we know it was built after 1839 because burning the tally sticks burnt the House of Parliament down.
But you could pay tax. You could
But
pay tax.
You pay tax with them. There's also stories about the extent to which the English were embarrassed by them, with the sophisticated attitude of banknotes and being a global power. The idea of using pieces of wood to pay your tax was seen as too damn primitive. And I think in that particular fire that actually burnt the building down was a decision, let's get rid of all of them. Let's burn them all. And it got out of control and burnt down the building as well. So I think it's total justice.
Yeah.
Credit money took down the bank, took down the House of Parliament.
It's technically charter money because it's been issued by the states against redemption, but it is, they all work in the county plan.
And they were private institutions as well in that sense. They evolved together. So I really recommend reading David's book on this front about the role of credit and saying that rather than commodities being used for exchange, which is the barter concept, and then a particular commodity being chosen, so we get gold coins, and then way later we develop this idea of banking and credit. What David argues is all exchanges started off as based on credit, and then money evolved out of that, and coins and stuff post-date credit by a couple of thousand years. So it's well worth having a read of that book. Now, today when we look at what we have as bank notes, they're no longer privately issued. Okay, they're issued by the state. And what conventional theory is doing is treating them as though they're just another variant of commodity money. And on this front, there's a lovely paper by Michael Kumoth where he satirises the way in which the conventional theory thinks about money. Because the idea about money is when you deposit your money at the bank and it gets lent out to somebody else, you can't use that money anymore. The other person's got the use of it. And he said it's as if you're dumping a load of gravel at the bank. And then when the bank lends out the money, somebody comes with a shovel and takes some of the gravel away. And it's a wonderful satire in otherwise a very technical neoclassical paper saying this commodity view of money is completely fallacious, but it's the one that dominates the mainstream. So what the endogenous money theorists first of all looked at, there wasn't as much, back when Basil was writing, there wasn't as much knowledge about the anthropology and history of money as we now have with work that David's done and Michael Hudson as well, and also Cornelia Wunsch. A whole range of people have gone back and looked at the original documents and found how much credit played an essential role in societies 5,000 years ago. What the theorists like Basil looked at was what appeared to be the reinvention of credit during the Renaissance, when you had private banks that used to be goldsmiths starting to issue notes rather than transferring around the physical gold. So Basil's argument here is that the innovation they made was the banking house found it could forget about handing out gold and silver itself and just have a note saying this represents ownership of a certain amount of gold and silver in the vault, and then people would accept transfer of those documents as being the same as transferring the gold. Now, this may be a sort of fantasy history in some ways, because looking at David's work and what we now know, we have the idea of credit going back far beyond the development of these Renaissance banks. But that's the history you'll find in Basil Moore. Again, it's a reason to read a large amount of material. Don't just rely upon one particular source, because a lot of economics attempted history is sort of pseudo-history. It's not actually as fully researched as the work that David has done and that Wunsch and Co. have done in translating original Sumerian cuneiforms to see the existence of credit contracts 4,000 and 5,000 years ago. So the essential difference is an essential difference between money which is created as a commodity, or money which is created by the state and fixed supply, and credit money. And this is again Basil making this case here that what he called modern monetary theory, by which he means the neoclassical theory at this point, has an approach to money which is appropriate when money is a commodity, without recognising the difference between being commodity and being credit, because a commodity is limited by how much you've actually accumulated and how much you can actually mine at the time, whereas credit can be created, even by the stroke of a pen. And what the monetarists are doing is treating it as if it's under control. There's an independent supply function of money. And, if money's commodities or it's a fiat debt of the government, then you can imagine that it's independent and distinct from demand. But in a credit money system, this is again Basil Moore's work, the supply of credit adjusts to the demand that exists for it. So because commodity money is a material thing, it's an asset to its holder but a liability to no one. So if you have gold and gold can be used for exchange, then it's an asset to you, but it's not a liability to anybody else. Whereas when you look at credit money, it's both an asset and a liability. So there's no independence in supply and demand. This is again the argument he's making to get rid of the idea of a supply and demand analysis. The stock of money is determined by the demand that borrowers have for credit. So the quantity theory equation, let's take a look at the impact on that. So if you look at the quantity theory equation, I've rearranged it. You normally see it as being price times transactions is equal to money times velocity. But in fact, let's look at it the way it's actually defined. It's a definition. You have the monetary value of output and you divide by the stock of money. That's how you measure V. And of course what you put down as V is something depending upon what actually type of definition of money you're looking at. So the price level there, you have the level of output, GDP, so you've got to, you try to work out nominal as well as real output. There's a stock of money, whichever definition you're looking at. So V is just a ratio between the three. And what Friedman and co. did was first of all argue that V is stable. So a major part of Friedman's monetary history of the United States was trying to show that V was very stable, didn't change over time. Whereas endogenous money argues that it's highly variable. Okay, the relationship between the two, between the amount of the money value of output and the amount of money can vary quite dramatically. Now, what you look at when you look at the statistics, it absolutely supports the endogenous money case. V is anything but stable. It's highly volatile, and it'll rise during a boom and fall during a slump. And it's also, for the last 30 years or so, had a very strong trend to decline over time. And I've got a lot of good arguments about it coming up in next week's lecture. So, first of all, the endogenous money case, while still looking at the quantity theory equation as a reference point, said the equation's flexible and it works backwards. So if you look at this causation here, if M is inflexible during a boom, for whatever reason, if it doesn't change very much, then you can have financial innovations that will increase the velocity of money. The banks will form other institutions that enable money to turn over more rapidly. But the main point that was being made by Basil Moore is that changes in the price level, in particular, and sometimes changes in volume as well, force changes in the money supply. So rather than Milton Friedman's argument was that this was stable, V didn't change. This was given by real factors. There was no monetary role in determining real output. And this was under the control of the government, so changes here caused changes in prices. That was effectively what monetarism was. And what is being argued by Basil Moore is that the price level is determined by wage demands, by later again by demands for raw material producers to increase the price of their goods, and so like the OPEC effect. Any changes there in the price level will cause changes in the money supply through the endogeneity of money. So then you look at M being defined as the total stock of money is defined as being the monetary base times base money. And again, the classical argument was that the government creates B and the government sets M, so those two determine this one. And what Basil's saying is, well, bank loans actually cause changes in that relationship or force the government to change the amount of base money that it's got over time. If there's an increase in the amount of money being caused by extra transactions, then the government has to increase the amount of base money or it'll cause a financial crisis. And that Estonian example is a good instance of what could happen there. Yeah?
I mean, ironically, the causality you just described basically says that changes in P&T in the economy will flow through exactly into changes in M, which actually means that D would be stable, no?
More stable than it could be otherwise. And when I simulate it, I actually get that result. It's quite intriguing. When I have the neoclassical position where there's a fixed amount of money, then V is quite volatile. When I change across to, and I'll show you this in Minsky next week, when I change across to saying the money supply will vary, then V becomes relatively stable. Yeah, but still has those trends overall. So, looking again at this, when you had the quantity theory as your reference point, this is what people were being taught back in the 60s and 70s when Basel was making this case. He had to make a lot of his argument about why the equation works backwards. So if you look at you can say the central bank controls the base money, but its primary function is to guarantee the smooth functioning of the payment system, meaning that if you want to go and buy that Tesla, then even if your bank doesn't have enough reserves, the transaction will still happen. So in that case, it's got to guarantee deposit of funds and guarantee people trust what's in their banks. So therefore, if a bank gets into trouble, if you have too small a level of reserves there, it'll relax its emphasis upon the money multiplier ratio, if indeed they have one. Of course, most of them have abolished it. Or it'll expand base money to suit. And here's an argument, this is Basil's argument again here, the need for an elastic currency to offset all the shocks that come through in a typical economy and avert chaotic changes in interest rates and financial crises was the major reason why they formed the Federal Reserve in the first place. So it wasn't there to control the bank, the amount of money, it was to make it function more smoothly.
So the bank is central bank?
Yeah. So he said causation runs backwards here as well. The amount of money in circulation that has been generated by the monetary system will determine what the ratio ends up being and how strictly it's enforced as well, or the amount of base money being created. So the best criticism of the money multiplier actually comes from Alan Holmes, who was a deputy president of the New York Fed, the research director, I think at the time, and he was actually fighting a rearguard action against Milton Friedman because, as much as I'm satirising this money velocity equation, Friedman was asserting that was how the real world operated, and the central banks were adopting this to try to control the inflation rate. And Holmes was saying you can't use the money supply to control the rate of inflation in the economy. You don't have control of the money supply. If you impose these controls, the only way you're going to cut inflation out of the economy is by causing a serious downturn, which is in fact what actually happened by trying to try to control the amount of reserves and control the interest rate on reserves. So he said the belief that you can control the money supply, and I love this, suffers from a naive assumption that the banking system only expands loans after the system, meaning the Federal Reserve, have put reserves into the banking system. In the real world, banks extend credit, creating deposits in the process, and look for the reserves later. So rather than the whole idea that Friedman has was the amount of reserves was a control mechanism. And by controlling the rate of growth of the money supply, you could therefore stamp inflation out without having much effect upon the real economy. That was the argument Friedman was making, and the profession accepted it. And people like Holmes, from inside the system, and Basel from outside were saying, look, it's just naive to believe that's how the monetary system functions. They're saying the question becomes of whether and how the Federal Reserve will accommodate the demand for reserves. In the very short run, there's little or no choice about accommodating that demand. Now that comes back to my example about somebody wanting to go and buy a Tesla car. Okay? If they don't accommodate the demand, then ordinary transactions get voided. Because people have got enough money in their bank accounts, but banks don't necessarily have enough reserves to match those transactions at any particular point in time. So in a given statement week, the reserves required by the banking system are predetermined by the level of the deposit existing 2 weeks earlier. Now, funnily enough, when you look back at the history of it, there used to be a 2-week lag between need for reserves and actually having to settle those. So if you had a bank with insufficient reserves for the purchases its customers wanted to make from people who had bank accounts in other banks, then they had 2 weeks to fix it up. And now we have 4 weeks. And in Europe you've got 2.5 months. So the whole idea that the reserves play a control role is just nonsense, because reserves are actually set by what was required to be in the banking system 2 weeks ago, back in the 60s, 30 days ago, which was the rule in 2009. It may have shifted. In Europe, 2.5 months ago. So the deposits determine the reserves, not the other way around. So he said excess reserves run at frictional levels. The level of total reserves in a given week is also determined well in advance. So reserves aren't a control mechanism, they're a result of private bank lending and the settlement process between banks. That's what they actually play a role as. And the whole idea, therefore, that you can have the money multiplier argument is nonsense, okay? In a strict institutional sense. So he says banks have to meet their reserve requirements each week, and they could do nothing to affect their required reserves. The total amount of reserves has to be available, and the Federal Reserve has discretion about how they'll actually acquire those reserves, whether they borrow from the central bank or have to borrow from other banks or from open market operations and so on. But, pardon me, I've gone a bit too fast there. Let's go back up. So there's some discretion there about the way in which those reserves are supplied, but not discretion about supplying the reserves themselves. Because if you don't supply the reserves, you cause the payment system to break down. So, and again, here's Holmes really on the attack. The suggestion you could use open market operations to prevent a rise in total reserves through bank borrowing is completely illogical. Within a statement week, the reserves have to be there. One way or the other, the Federal Reserve has to accommodate the need for them. So this is why the reserves can't control deposits. The idea that the base money can control M is completely wrong. It's M that determines how much base money is going to be there. What you now get when you look historically, that in 2009 this paper came up by O'Brien as a Federal Reserve paper. They've almost been abolished where they do exist. So this is an excellent paper to look at the actual practicality of banking. And you find that almost all OECD nations, the reserve requirements have massively lagged. The US reserve lag, which was 14 days when Holmes wrote, in 2009 was 30 days. What they call a computational period and a maintenance period, a 30-day gap between the two. So you calculate in one day what your reserve requirement is, and 30 days later you have to meet it. So you've got 30 days to find the reserves if you don't have them at the time. And this is the table that's summarising it at the back. It's a bit too small to see there, but this is the United States and the UK. So the UK, there's about 4 to 5 weeks. That's what the MP here stands for, the maintenance period. Everything is lagged, and then the key lag is this one here, a 30-day lag. And there's about 7 or 8 OECD countries that don't have reserve requirements at all. They just abolished them.
In the UK, it doesn't even work that way. You just, before 2008, before interest on reserves, the way the UK economy works, you simply stated before the maintenance period, which is roughly a month, what your average level is going to be, and then 2 weeks after the maintenance period finishes, it will be publicised whether you have failed to hit that average aggregate target.
Yeah.
That's how they hit it. So the banks set their reserve targets themselves.
Right.
And then the idea was that they were then punished or rewarded, that they would be penalised for failing to hit their own target.
Yeah.
But we don't use that system anymore because obviously the reserve balance is a wash now.
Yeah. There's so much excess reserves now with QE.
Remuneration rates. But that's how it works in the UK. All the regimes are working in the same way to build a corridor.
Yeah.
So that's how our one works.
Yep.
Does anybody look at capital requirements? Because the evolution of the markets and so on over the last 30, 40, 50 years, there's a lot more products and a lot more ways of getting around things like cash reserve.
Yeah.
And I wonder whether maybe the fact that reserves are getting pretty much, they're not able to do the job.
Yeah.
Maybe capital has stepped in to do that job.
And that's pretty much what has happened. They've tried to control bank lending by controlling the types of capital you can invest in, and the extent to which that's taken as how the assets are valued. You value the whole the risk weighting that's applied has now become their way to try to control bank lending.
Limitation now on
that's the real, but it's
not just lending, but any kind of risk that banks can take.
Yeah.
Every kind of risk is included in capital calculations, and that's like a real limitation now, because the sort of stuff got so much more complicated that this kind of thing that wouldn't actually limit what they can do anyway.
Yeah.
It can do it, but capital will work for a single bank, but not for the banking sector as a whole. The banking sector as a whole can produce its own capital. Exactly. Because
yes, it can.
Barclays attempted to buy its own equity with its own deposits and got busted for it. But as a banking system itself, it can essentially it can create its own capital as a system, which is why it grows together in line. Banks will have to move together as they expand their books. One can't race out, then it will get smashed in the way you described. That will limit it. But as a system, it will...
Yeah, but the valuation of capital assets reflects the level of lending the banks are willing to do to finance their purchase to begin with. So you get a feedback process. The amount of money they're creating to enable banks to buy various assets can drive the prices of the assets themselves and then create the ratio that the banks are supposed to fulfill.
And Michael Kuhhoff accepted that rather than accept that there are limits to what capital ratios can do within Basel, or limits to what you can achieve there. It forces arbitrage through different Basel regulations, which create all kinds of interesting effects, but the single banking system, it doesn't impose a ceiling.
Should we take a break there and come back in about 10 minutes? I've gone a bit over time there.
If they don't get the reserve requirements in that material, they get fined.
Yeah.
They get fined.
Yeah, but not anymore. I mean, the fines, it's so easy to fulfill that the fines are irrelevant.
Irrelevant.
Oh yeah, you can. They're recorded as being there, but you can borrow the money from the banks, other banks. If you have a huge purchase from one bank to another, effectively like you one customer to another customer in different banks, that transfers reserves to become excess for the bank that's now got them. So the bank can actually bank the reserve can borrow them back.
So you would say in that it's irrelevant with this limit time, this deadline.
Yeah, it's irrelevant. Yeah.
So did you get all the files yesterday?
Your details for the new
because
school.
it was quite a big compilation of files. You got all 3 files?
I think I got all 3 files.
Okay,
yeah.
great.
So I'll check
Thank you
them
very much for doing this so nicely.
It's a bit difficult because I don't know enough about you to really. So I've got to look at what you've written before. And
that's very nice. Thank you for still engaging. It's very nice.
You're welcome.
So bank stability basically depends on, let's say, as long as they have some kind of credible assets, which they can use to get as a collateral to banks, or repayability of their loans. So maybe
That's the main one is whether the loans are being repaid, because if you have too many bad loans, you're going to have a loss adjustment account. But if those failed loans wipe up the loss adjustment account, and the only way to finance your equity runs out, you fail.
By the way, I believe that being a banker is the most secure job in the world, because if you fail, someone is going to save you.
They've got to hide you. Yeah.
Escape in some way, because over in the end you will get so much money for because a lot of the bankers that the banks that failed the crisis, anyway they got not in those words. When you go out of job and they give you money.
Bonus or
yes, then at the end
the golden
piece and bonus not to get broke. So basically, it's a bank that was. Have you heard of what happened in Italy recently?
No,
some local banks failed, and the government had to save them.
Yeah.
But only accounts less than 100,000 euros got saved. because the bank
more than $100,000 actually lost their money.
Yeah,
Oh my God,
and the problem was also that when the banks made these people sign obligations, it seems without telling them that there were obligation of the same bank.
Yeah.
So when the bank failed, they failed too. Basically, this is what happened.
Yeah.
There has been a huge debate in Italy about that.
When was that?
And there was also a problem because one of the minister of the government is one of the bankers' daughters. No, recently.
You just want the glory of being who he is.
No, actually it came last semester.
That's how
I was crazy. I thought it was so bad. I didn't want to recommend it to everyone. I expected so much more. So I wanted to say that.
When did you start?
Can you write that down for me? What do you mean? Give me some time so I can see.
May you have
organize and help us put pressure on the
Yeah, May.
It's not all the time. That's methodology, right?
What? What's for normal? No, just 2 weeks. And I think it will be.
So what they do is change.
But when
Just do whatever they want.
you start studying,
They just change them.
okay, me too.
That's basically what they're like. So, just a genuine, send Facebook to all your friends and
I
should see all that feedback I have a fan base on my blog. Yeah, I was elected as a representative.
dishwasher.
A friend of mine just was for next college.
Yeah. Yeah.
Back in Wales as well. It's mainly South Wales, Victoria, I just walk by.
Probably the best month is the least chance of rain.
Yeah.
Or the chance of the least rain.
Okay, yeah. And my family is coming in August. And we're going to go yeah, so yeah, we are planning very different. Well, I personally, I love it, so the reason, so maybe that's for 1 hour.
Maybe half an hour,
And there's a little train as well, so if you've got people that are like don't want to walk out.
You can understand too.
How do you say
this meeting tomorrow.
today? Oh, today? Yeah, I'm working today. The Skype. Yeah, but I'm working. I start work at 2, and I'll ask you for rest, but it's scheduled to 2 to 5, and I'm sorry. I work like very nice.
I don't want to share. I did my share, now you do yours, you go. You can go for 3 days. Yeah, you go for 3 days. Smart. That's what an economist
Yeah, I know. So whenever the message, I wanted to say 8, and I was like, yeah, the thing is,
you have to pay your family? So,
okay, and then
Friday.
We need to go to the theater. Show some I heard about
I'll do this.
Sorry, Joanne, the one in Joanne, the comment.
But she just said
It happens, let's see. Great, okay.
yeah, I don't know.
Yeah,
I'm going to hope he's going to
Oh, hang on a sec, I forgot to stop the recording. Oh, no. Oh dear, hang on a sec, it says... The time as I seem to do most of the time. Hello. Okay. So when Basil was writing, banking was much more focused on providing working capital for firms. As mentioned here, these days, and one of the reasons why the financial crisis was so severe is that the commercial paper market became the way banks actually got their short-term funds, and the failure of Lehman Brothers brought down the one company that had cornered the market on managing commercial paper. So that's one reason the crisis was so severe when Lehman went down. But you're seeing the primary need, back when he wrote, banks were providing working capital for firms, and the primary need they had was for new wage and material costs. Interestingly enough, Fama, sometimes you'll find neoclassicals do really good empirical work, despite their theories. And here's a classic by Fama in French, where they had a couple of papers that published, one on the web, a couple you can find in the literature, where they say when they're doing the empirical work, debt tends to be the residual variable in financing decisions. Investment increases debt, and higher earnings tend to reduce debt. That's exactly the equation you'll see me using later for Minsky's financial instability hypothesis, the argument that's the role that debt predominantly plays. And again, later papers they talk about what they did here, they took the CompuStat database in the United States, which is a very comprehensive database of company reports for a large number of major companies, and they analysed the data about the level of investment, profitability, debt, etc., and looking at various theories about what determines investment and borrowing. And they found that the main thing is the main link between investment, or main thing investment was linked with, was long-term debt. The strongest correlation they could find by far was between investment and long-term debt, not the other factors they thought that might determine the level of debt that's taken on. So you have the expansion and contraction of credit with respect to the needs for firms being the main mechanism there. And writing back in 1990 or the 1990s, Basil's talking about firms having a new demand for wages, a new change in material costs or some investment demand, and the firm then just extends its line of credit, and then that changes the amount of money in the economy. So new deposits are created with the loans. And the central bank then, because the central bank has to enable this expanded amount of money to still enable banks to balance their accounts with each other, then the central bank has to expand the reserves to whatever level is needed to enable that settlement to take place. So you have causation running from the price level and transactions to the amount of money, and therefore making V potentially volatile. So it goes from money base, from the stock of money to the money base, and not vice versa. And the neoclassicals again find the same reality. If you look at the empirical work done by, again, a couple of staunch neoclassicals, Kydland and Prescott, you can't get more neoclassical than Prescott, in an interesting paper where they were trying to support real business cycle theory. Ironically, they came out critiquing real business cycle theory, but they were the founders of it. That didn't stop them believing in this stuff, as you saw that quote I gave you from Kydland back in 1999, I think in last week's lecture. But I find this a really interesting paper where they did a interesting filtering approach to look at economic data and look at the timing of different series, and they found the timing sequences supported post-Keynesian literature, not the neoclassical. So what they did was they looked at, took a whole range of variables that their own theory tells them are important. Of course, they therefore ignored the level of private debt in their analysis. But the basic argument was that if you found that a particular variable followed another one in time, once you'd removed any secular trend to the data, then it's very hard to argue that that the one that follows the one in time actually causes the one that came before it. Now, there's some issues about that if you look at a complex nonlinear system, and there are feedbacks that can actually make that much more complicated. So I don't think this is necessarily the ants' pants in how to analyse the empirical data and make conclusions about what causes what, but it's still quite intriguing to find how strongly their results contradicted neoclassical theory and supported post-Keynesian. So if you're going to have money being exogenous, if money is completely independent of the economy and set by an agency outside the economy, then it has to be either uncorrelated to your real variables or correlated to them and lead them. So changes in the money supply cause changes in the price level. That's what you should be finding. And what they found was, and this is a nice little summary here, that there's no evidence the monetary base or M1 leads the cycle. So rather than the monetary base and narrow definitions of money determining the economic cycle or determining changes in prices, they found the monetary base and M1 are generally pro-cyclical, and the money base lags the cycle. So the money base comes after changes in economic activity. So if you using M0 for the money base, then you can't argue that changes in the money base cause changes in output or change in prices, which is Friedman's case, if the money base lags changes in output, which is what these guys found empirically. So what they did effectively was to look at the data and just say, what does the data tell us, without having a theory beforehand. Now, of course, the theory just selected the facts they looked at. So they didn't look at levels of debt at all in this analysis, because that doesn't play a part in their theory. But they did look at M1, M0, they looked at prices, they looked at wages, etc., etc. And it was just a fact-finding exercise. And the purpose was just to see if they could find, given the theory that told them what they should expect to find, do the actual business cycle data correspond to the patterns they find that the theory says they should find. And what I found quite intriguing is just how blatantly they said the theory contradicts, or the data contradicts their own theory. We find these features interesting because the patterns they seem to display are inconsistent with the theory. Now that to me should have caused a huge change in the theory, but it didn't happen. Yeah, Severin.
I see how there's contradictions. Are there any classical models like those that contradict real business cycle?
Real business cycle is the heart of neoclassical theory.
At that time it was.
Well,
at that time it was starting to become that, but I think what they're arguing against is the kind of Friedmanite stuff where the money supply adds to the
money supply to exogenous. Changes
Yeah.
the exogenous money supply do have real effects in the short run.
Yeah.
But whereas in real business cycle theory, it doesn't really matter whether money is exogenous or endogenous because everything is determined by real factors, right?
Yeah, but they also found some monetary real causation as well. But I take the point they're mainly critiquing Friedman in that case. Yeah. So, yeah, fair enough. But they also, some of what they found did contradict real business cycle theory as well. And they end up with a conclusion that argues you've got to include the monetary system in the economy, which is not at all what real business cycle theory argues. I'll show you that at the end of the paper anyway. But you're right, they are critiquing Friedman more than they're critiquing themselves. So what they did was they had a very simple definition of cycles, just saying cycles are deviation from trend. So you have to define a trend using the data itself. And what they developed was a filter that looked at the trend and the cyclical components and tried to find a way to minimise the variation around the cycles. It's called the Hodrick-Prescott filter, and it's actually quite it's a linear filtering technique, and you're applying it to nonlinear data, but it's something that physicists also themselves invented some time ago. Economists ended up reinventing something that physicists basically did. So you're trying to take data and remove the trend from it, and then what you're left with is the cycles. That's the basic idea. And just to show it in a sort of graphical way, you've got, say, here's data for nominal GDP in America from 1959 to 99. And then what you do is, with that data, you first of all take the logs, so you get, the straight line is implying exponential growth. And if you had perfectly straight line, then it'd be perfectly smooth growth. Obviously it's not. You've got cycles around it, so it's clearly cyclical in some way. So what you then do is you subtract the trend from the data itself, and that gives you the cyclical components. What I've done just here is I've simply taken a moving average, a 4-period moving average, and that's what I've taken as the trend through the whole system. And you subtract one from the other, and you get the cyclical component. That sort of idea. So that's the log of the US GDP minus the log of the trend. And those are the ups and downs. Then you do exactly the same thing for another series. So you do this for investment. Now there's the data for investment, and obviously much more volatile than the data for GDP. There's the 4-month period moving average for fixed investment, and that's the variation. So that's the basic idea of what they're doing. And then with those, what they then do is compare the leads and lags of that residual variable data. So you overlay the two. So that's the log of the GDP minus trend overlaid with the log of investment minus trend. And you can see how volatile investment actually is. And then the conclusions they arose out of what are the leads and lags in those cyclical components. So here's the first, again repeating that statement, that the monetary base doesn't lead the cycle. Okay, and the monetary myth they're talking about is Milton Friedman's monetarism there. Both the base and M1 lag the cycle. So M1 lags the cycle. And then what they also found, this is the stuff which starts being intriguing as a critique of their own real business cycle theory here, because, again, in real business cycle theory, money plays no essential role. But they're saying the behaviour difference of M1 and M2 suggests that the difference should be considered. That's mainly interest-bearing time deposits, etc., equal to about 1/2 of annual GDP. This difference, which is fundamentally credit money, leads the cycle by even more than M2. So changes in credit money are leading the economic cycle, and that's why I say it's critiquing just the real business cycle way of thinking. And then the money velocity is also pro-cyclical and quite volatile. So you have the money, broad money leading the cycle, while M1, let alone M0, lags the cycle. So you can't argue that base money is causing changes in broad money. And they ended up finding, and here's another intriguing one, that the transaction component moves with the cycle, where the non-transaction, which is credit, precedes the cycle, which suggests that, and this is clearly non-real business cycle thinking, that credit arrangement should play a significant role in future business cycle theory. So they're saying we should have a credit theory of the business cycle, which is the last thing that the neoclassicals actually did. And this is the concluding sentence, I think, in the paper. Introducing money and credit into growth theory in a way that accounts for the cyclical behaviour of monetary as well as real variables is an important open problem in economics, which they did not address after they wrote this research paper. So this particular piece of empirical research, like the one by Fama and French, support what the post-Keynesians are doing, not what the neoclassicals themselves did or ended up doing after their conclusions. So you need a theory where credit plays an essential role, where V is variable, and rejects the proposition, again, the monetarist, the Milton Friedman as opposed to real business cycle argument, that base money controls broad money. And then also you've got to find a way that a model in which V is not stable. So the whole idea that money supply increase causes inflation, which is Milton Friedman's argument, goes out the window. So you have money being endogenous, not exogenous, interacting with real variables, not just causing inflation, which is the neoclassical case, and having causations in the reverse direction to conventional theory, all of which supports the post-Keynesian case. And to me, it's so frustrating that it's still seen as a minority, lunatic fringe of the profession when the empirical data and even leading neoclassicals end up empirically supporting it. So you have a money supply which can expand given the demands of the commercial sector, not just by what the government decides to do with the central bank, and where credit money carries debt obligations, so debt turns up as being an essential part of the system as well, which again is Minsky's argument, and it's what Fama and French's empirical research found. So it's a persuasive case, and it requires a monetary vision of the economy, not just as a barter system onto which you impose cash, which is what the neoclassicals have always been trying to do to explain where money comes from. So you necessarily, if you have credit money, you necessarily have debt as well. And therefore there's a relationship of some sort, which I want to articulate in the next couple of weeks, between debt and money and the impact it has on the real economy, not just on the price level. And again, what neoclassical theorists tries to do is to argue that monetary variables just affect price levels, fundamentally. They don't have any effect on the real economy. This is an argument that says it has an essential role both in the short and the long run. So the idea that money is just a bail-over barter and the object of trade being consumption, the vision that the post-Keynesians have is that money is fundamentally different to a barter. A monetary economy is fundamentally different to a barter economy. And what you're looking at is the accumulation of money as the essential object of what you're doing, not just getting commodities for exchange. So if you look at Say, and go back and look at this proto-neoclassical back in the early 1800s, his argument about the role of money was just basically to dismiss it, and that's still what neoclassicals tend to do. So here's from Say's Catechism on Political Economy. This is how he dismissed the role of money, saying every producer asks for money in exchange for his products only for the purpose of employing that money again immediately in the purchase of another product. We don't consume money, nor is it in ordinary circumstances sought to conceal it. I mean, it's lunatic stuff. Obviously, we hide the amount of money we've got. People don't immediately buy to immediately spend. Even there can be a time lag. So fundamentally, this is the argument about barter, that producers, though they have the air of demanding money for their goods, do in reality demand merchandise for their merchandise. So you can drop money out of the equation. And that's really still stuck in the brains of neoclassicals. Now, Marx, on the other hand, of course, gives the completely alternative argument that the purpose of capitalism is the accumulation of wealth. And the battle over barter is saying that traders just want to exchange what they have and don't want for what they don't have and do want. And Marx is saying, well, okay, so far as use values go, yes, in an exchange each side gains. That's the neoclassical angle, that it's all about increasing the use value of each of the parties. We said, but even given that that's what actually happens in an exchange, it's not the main game. It must never be forgotten that what matters is not the immediate use value, but the exchange value and the expansion of surplus value. That's the driving motive of capitalist production, and it's a pretty conception that abstracts from its very basis and depicts it as a production aimed at the direct satisfaction of the consumers in order to reason away the contradictions of capitalist production. So I think Marx has definitely got his feet on the ground correctly. Money is the ultimate form of accumulated wealth, and that's what capitalists are after, and that's what you've got to look at as well. And Keynes also sends up the entire idea of the veil over barter, because that's asserting, as Say did in that particular phrase, you don't get any utility out of money. And Keynes is saying, well, the utility it gives you is certainty, some degree of certainty in an uncertain world. And again, back to that phrase from Keynes earlier, that it serves two principal purposes, a stir of wealth, but he said, but what a crazy world of use that would be in a world in which there was no uncertainty. So again, the tie between money and uncertainty. Why should anybody outside of lunatic asylum use money except as a store of wealth? Because it lulls our disquietude about our own beliefs about the future. So you've got a money system being essentially different to a monetary commodity-based economy, and money itself essentially different to commodities. Because in a crisis, a hoard of money can be useless, but a hoard of commodities can be useless. You can hoard the wrong commodities, but if you hoard money, then you've got something which gives you some sense of security. And it's it's gone to the loans create deposits view. So the money multiplier model, you have government money driving credit money. In the endogenous money case, the causation is effectively reversed, but certainly credit money creation is independent of government money creation. So the banking system creates credit money, fiat money is created by the government, we store them both in private bank accounts, and the Fed has been trying to control the ratio between the two by setting that target. But the primary role that the Federal Reserve has is to maintain solvency. And to do that, therefore, credit money is going to drive base money, which is the entire disposition of the post-Keynesian school. So we need a theory where money and credit lead the cycle, and that's where the circuitous come in. And I really didn't have the ability to pull together my own modelling approach to economics until I read Graziani's work on this, and a paper called The Theory of the Monetary Circuit. And in that paper, which is now actually physically downloadable, that's a link to the paper. It's in the Thames Papers in Political Economy. So if you click on the link, you can download the paper. It's only been available in the last 3 or 4 weeks. And he did a beautiful piece of working from first principles about the nature of money, and said there are 3 conditions that are necessary to define something as money. First of all, to be money, you have to have a token which has no worth in itself. Otherwise, you're talking about a barter economy. If you say gold is money, all you've said is I'm using a particular commodity as the form of barter exchange. It's not a monetary economy. So it's got to be a token. So a commodity is something that anybody can make. If you have a commodity money, anybody can go and mine gold, or anybody can go and find cowrie minerals. So it's still just a particular commodity. So a true monetary economy must be using a token, he said, which is nowadays a paper currency. By paper, by the way, he doesn't just mean paper notes. He also means checks, check accounts, writing on a check, which is when he was writing, again, we didn't have electronic money as we have it now. So he said secondly, money has to be accepted as a means of final settlement. Otherwise, it's just credit. So if you have a trade credit deal, somebody will give you the goods, but you're in debt to the person you've got the goods off. So that's not a final settlement. So money has to be accepted as a final settlement. And thirdly, it can't give right to seigniorage, meaning that it can't be the person, the entity that creates it, can't create it and use it for its own spending. Now, of course, the government can do that, but a private bank can't. So if you have seller A and buyer B accepting tokens issued by Bank C, then Bank C can't just print those tokens whenever it wants to go shopping. Okay, it has to earn the tokens it gets, not just create them and use them straight away. Because that would be like paying for goods with IOUs. We're getting too much sunshine on the screen. You want to put one of those shades down there? I find it ironic. I've got to keep asking people to put shades down to cut down the sunshine in London. But it's true. Okay, that's a bit better. Okay. So, and this is, I think, the incredibly deep insight coming out of Graziani's work, that if you're going to have a monetary vision of the economy, you have to have exchange being 3-sided, not a 2-sided process where you have a buyer selling a commodity to a seller who's selling a different commodity. But you have a buyer buying a commodity from a seller by transferring money in a bank account, but there's only one commodity involved in 3 parties, not 2 commodities and 2 parties, which is the neoclassical way of thinking about it. And that makes banks an essential part of capitalism. So here's Graziani elaborating on the use of paper money as a check. When an agent makes a payment by means of a check, he satisfies his partner by the promise of the bank to pay the amount due. So he's saying money is the promise of a third party that we all accept in terminating a commercial transaction between 2 other parties. So once a payment is made, no debt and credit relationships left between the 2 agents, but one is now a creditor of the bank while the other is a debtor of the same bank. So there's no seniorage going on there as well. So and this is, I think, a brilliant insight. For any monetary payment system must be therefore a triangular transaction involving at least three agents: the payer, the payee, and a bank. So real money is therefore credit money. And that triangular vision was what ultimately led me to building Minsky, the Minsky software package, which I'm taking you through in great detail next week. So you have this vision of a seller with commodity X to sell, and a buyer with money in a bank account, and a bank that does the transfer. Those three elements, that three-sided system, compared to what the neoclassicals talk about, which is a barter system, where you have a buyer and a seller, A, who's got a commodity X and wants Y, and a buyer-seller B, who's commodity Y and wants X, and they then work a relative price between the two of them, and no bank is involved. That's the neoclassical vision. But the essentially true vision is the one with the circuitists explain. What you're looking at, the neoclassical vision, is a model of primitive economy with barter, but not a model of capitalism. So just to go through, and you can't call money a commodity. It's this sort of relationship. A is selling cameras and B is selling apples, and they work out a relative price exchange. That's not capitalism. It's not a banking system. So money is a non-commodity. And again, this comes back to Marx's arguments that I took you through 2 weeks ago as well. The fact is money is both a commodity and a non-commodity. So a true monetary economy is using a token, which is nowadays a paper currency. We'd now call it an electronic currency. So you have three-sided, single commodity financial exchanges. That's the sort of thing we're modelling in capitalism. And I've got to improve my graphics here. These are fairly old graphics, but I want to make that triangular vision. You have a bank at the apex and a buyer and seller at the base. I'm showing at the top up here. But the basic idea, you're selling a commodity, and to make that commodity transfer, you've got a transfer of money inside a banking system. And that's the essential monetary vision of capitalism. So they're all three-sided, and importantly, you can't lump banks and firms together because they fulfill essentially different roles in capitalism. And this is about, again, Graziani. They must be considered as two distinct types of agents. Firms are present as buyers and sellers of commodities, and they go to banks to get payments. Banks produce the means of payment and acts of clearinghouse in firms. So in the monetary model, banks and firms can't be aggregated into a single sector. Again, that's what the neoclassicals tend to do. They just treat banks as another form of firm. So I think there's incredibly good insights in that paper by Graziani and all of Graziani's work, and I do recommend reading it. But there are weaknesses where he tries to turn it into a model of capitalism for whole sorts of reasons. And I'll just go through the verbal model he has. So he starts by talking about having firms just measured as one commercial sector, and labour as a household sector, and banks as a banking sector. He doesn't bring a central bank into his model, but that's his starting point. So it's a model with no central bank. And what he sees is banks grant finance to firms, so they make a loan which enables the firms to start production. And then he says the loan is entirely to enable the firms to hire workers. And where I think there's some things which are exaggerated, I've got a question mark at the end of the statement. So he said if we consider firms as a whole, their only external purchase is the labour force. And then he says only at the end of the production process do firms buy capital goods to be used in the following period. So he's leaving out intra-firm sector purchases. So firms hire labour at the wage rate, and he's leaving out how wages are actually set. And what he actually then starts to do, and this is one thing which you've got to be careful in reading a lot of economic literature, people will fall into neoclassical habits sometimes without realising they're doing it. And that's what he was doing here. He's effectively saying firms, once they borrow the money, the entire loan is then transferred across to the workers. So you borrow $100 million from the bank and you pay $100 million as wages to the workers straight away, okay? Which is not at all what happens. So he has workers being paid. No, that's what he effectively argues in this paper. They instantly pay all the borrowed money to the workers as wages. The workers then put the wages in their bank accounts, which means the workers are now the creditors and the firms are the debtors. And then he says, well, the wage earners have got two choices. They can keep them in securities or they can keep them in liquid form in bank deposits. I'm leaving securities out of the initial model I'll build for you later. but he's seeing them as having two potential ways of spending that money. And he says as long as money wages are not spent, an amount of money equal to the wage bill is in existence. So he's arguing effectively if workers spend their wages, the amount of money in circulation goes down, which I think again is a bit strange. And he said the total amount of money is a debt to the firms, to the banking sector, and a credit to the wage earners. So all the money's in the hand of the workers, none is in the banks, none is in the firms.
Isn't that because the workers are buying the goods from firms who are repaying their debts?
Yeah.
So the money circuit has to be extinguished. He's just relocating the point of credit is extinguished effectively when the workers send the money back to the firm.
But I think he's also putting a dynamic process into a static mindset, and therefore he's getting the two confused. And you'll find a lot of that turning up in that paper. So he's saying the workers either spend their wages or buy the bonds, and that itself extinguishes the firm's debt to the banks. Money which is spent goes back to the firms and it's available for repaying debts to the banking system. Now, he then says as soon as the firms repay the debt to the banks, the money initially created is destroyed. I've got to admit I got that wrong. I disagreed with that. I now think it's right. Okay, it took me a long time to get my head around that. And I think learning about double entry bookkeeping and making that a part of Minsky is what taught me on that particular front. So I'm wrong in some of my earlier papers on that front. But Graziani, in trying to work this through verbally and tending to fall back onto static equilibrium mathematical analysis and static equilibrium thinking, really has a lot of dilemmas. How do capitalists make a profit? And he said if workers spend all their wages, then firms get back all their expenditure and they can fully repay their debts and therefore there are no losses. But if wage earners decide to keep part of their savings in the form of liquid balances, i.e. bank deposits, firms get less back from the market than they've injected into it, and therefore there's been a loss. So if workers have any money left in their bank accounts, the firm's going to make a loss. That's a big question mark there. So he's saying workers have to spend all their wages for the firms to be able to repay their debts. What about paying interest? Well, he said at the end of the cycle, money initially created will not be totally destroyed. A part will still be in existence as a form of debt to the banks, which I'm not going to object to. But he then say if banks decide to grant firms the same amount of credit as they initially did, the total money stock in existence will increase. So he's seeing a need for the money supply to increase to maintain a stable system.
It all depends whether you see the exclusion of the central bank at this point of a simplifying assumption.
Which he has done, I think, yeah.
In which case that there couldn't be any new net financial assets in the system, the circle has to be complete. So forced to make that statement. But once you include the central bank, then it's much more easy to see where net financial assets came from.
I'm a bit dubious about the issue of net financial assets. We'll come back to that one later. But I think this is all just logically wrong. I think he's making a set of deductions from his theory which go through a static mindset that means he ends up making various errors. So I see the paper as having great insights initially, but then not properly expressed. I could never have done any of my work without reading this paper, by the way. Okay, but I found errors in the logic of it at the same time. So I'll just go a bit. He said, if workers spend all their wages, the money ceases to exist. You know, if workers spend everything they've got, then the firms will pay that back. Firms will pay that back to the banks, and the money supply disappears. Now, this I find a real sign of thinking in a neoclassical way, without being conscious of how much neoclassical thought still sits in his mind. So the assumption is therefore required for the existence of money stock, namely that wage earners spend their money incomes gradually over time. And he says this may seem to be an assumption of irrational behaviour if no uncertainty is present. So he's actually thinking he has to justify the statement that workers spend their money gradually over time. That's not irrational. It's the real world. You don't get paid 5 minutes past 5 on a Thursday and spend all the money 6 minutes past on a Thursday. You spend the money gradually over time. So it's a failure to think dynamically. So he's saying here that if wage earners keep part of their savings in the form of liquid balances, firms get back less than they've injected into it, therefore there will be a loss, and firms will be unable to pay the whole of their debt. And this is a combination of thinking in a static sense about a dynamic process and period analysis, which you'll find I absolutely loathe. I think it's just been a complete confusion for neoclassical economists to try to think in terms of distinct periods where things happen. So he's saying an assumption is therefore made and it is irrational. This there's something going wrong here. You've got, first of all, you're being told that capitalists can't make a profit if they borrow money. Then what about the real world? They're clearly borrowing money and declaring profits. And this whole idea that spending money over time is irrational. So there's all sorts of impasses that turn up in the circus theory. And this is a good friend of mine, Riccardo Bellafiore, who's got a very Marxian foundation for his thinking about political economy in general. And he's saying, assuming a propensity to seem equal to 1, firms will always get back the wage bill and be able to repay the banks, notice that brackets, interest apart. So they can't actually pay the interest. And in the paper itself, he said, for the sake of its simplicity, we exclude the payment of interest to the banks. And I'm sorry, you can't imagine people are lending money without charging interest. That's not a simplifying assumption, that's a fantasy. So there's ways in which there are just logical flaws falling all over the place. And profits are gained in real terms. As said, in the basic circuit approach, firms can only get the wage bill back, therefore it's impossible for all firms to obtain money profits. There's plenty of companies declaring balance sheets which gives you profits in the aggregate, not profits for some and losses for others. There's all sorts of messes turning up in the circuit theory. And Louis-Philippe Rochon, another good friend, is the editor of the Review of Keynesian Economics. Louis pointed out that there's been a real problem for the monetary profit theoreticians. How do you explain profits? Okay. The theory itself reached this impasse. And he's writing here, I think, 2005 or thereabouts, that if you read the literature, firms can't pay profits and they can't even pay the interest payments. So how on earth do we get from M to M+? So there's a real logical hole in the way that this has been analysed, and it comes down to not being able to think dynamically because we haven't been trained in that sense as economists. But Keynes got it right, writing back in 1937, and Louis-Philippe actually reaches a good insight on it as well. And if you read Keynes in the other paper which I've linked to there, he said planned investment has to investment ex ante as opposed to ex post, rather than defining it by the residuals, saying what are people's intentions, has to secure finance before the investment takes place, before the savings occurs. He said that's be either by the issue of shares or by loans, whichever, it makes no difference, which is wrong. But looking back at the general theory, he had 3 demands for money in the general theory: transactions demand, a speculative demand, and a precautionary demand. What he's talking about here as well is a finance demand. He said, let's call this the provision of cash in advance, the finance required for current investment. In that sense, it's a special case of finance, okay? But he says, I now think I've done well to emphasise it when I analyse the various sources of demand for money. So he's admitting in this 1937 paper that he left out the finance demand for money, and that may well be a crucial element of how we think about the role of money in capitalism. So this is a finance for investment is a prelude to investment itself taking place, which then generates the savings later. So that was an essential insight by Keynes. And he then said, well, what happens with an initial loan? From his point of view, rather than the loan having to be repaid, which is the sort of thinking that repaid in one period, which is the type of thinking that Graziani was going through in that paper, he sees that it's circulating indefinitely. So he said investments proceeding at a steady rate. The finance required can be supplied from a revolving fund of more or less a constant amount. One entrepreneur getting the money, repaying the money, while another one gets additional funds. So only if investment is rising, if the economy is actually growing in size, will you need more money over time. In that case, you do have an additional demand for money. So the circuit theory in that sense is confusing a stock of a loan with the flow that loan can generate over time. So it is a stock flow confusion. And I'll take you through. I don't know whether I should do it today or next week. I'll get your opinion on that in a moment. So Keynes's reasoning here is really about the role of the monetary system providing money which is then turns over, and the turnover is the source of the profit. Whereas a lot of what the Graziani was getting confused with is seeing the stock of money as the source of the profit. No, it's the turnover that gives you that profit. So rather than money being destroyed when wages are spent, it continues to circulate. So the stock of money doesn't limit what can be done with the flow. Okay. but there's real confusions between stocks and flows in Graziani's thinking. So I do recommend reading the paper, but it's a challenge because there's so many bad ideas caught up with the good ideas in that particular paper. Yeah.
But the circuit theory is only one sub-theory of endogenous market,
Yeah,
because
yeah.
you would have the whole structuralist and the commodist approach also.
Then some of they say post-date the circuitous, but yes, they are. Again, I think they're divisions that would. It's a bit like the whole story about the blind men and the elephant. You know that particular fable?
No.
You haven't seen that fable? Let's say a bit of a satirical breakthrough, and I'll show you a wonderful little video if I can spot it quickly. Hang on a second. Let's see if I can find the appropriate one. What is happening here?
But I just wanted, would you agree more with like a commodist or structural approach? Or?
I think they're both incomplete. I'm more accommodationist, but I'll see if I can find. I'm trying to find YouTube. Hang on a second.
Which is the 37-page paper where he explicitly states that finance works and saving at random?
The alternative. That's the alternative theories of the rate of interest. Yeah. I'm trying to find a wonderful video here, but I'm not doing very well. But search. Some reason Google just seems to be breaking down for me in London at the moment, no matter which software package with Chrome. Let's see if I can go to YouTube here and find it. Let's see. Okay.
What's the one that we should do?
Pardon? Yeah, there's that. There's the general theory of investment, a very general theory of employment. I've forgotten the third one, but there's a third one as well. But this is sort of how I regard the. Here we go. The blind men and the elephant. Now, where do I find? Looking for a particular. Here we go. This is marvellous. I just hope the volume's good enough for you guys to be able to hear. Let's see if we're lucky.
The Blind Men and the Elephant, a Hindu fable. It was 6 men of Hindustan, to learning much inclined, who went to see the elephant, though all of them were blind, that each by observation might satisfy his mind.
Hang on a second. I'll see if I can actually. Let's see if this actually works. Hang on. Let's see if we're lucky.
It was 6 men of Hindustan, to learning much inclined, who went to see the elephant, though all of them were blind, that each by observation
I'll stop having.
may satisfy his mind. The first approached the elephant, and happening to fall against his broad and sturdy side, at once began to bawl, "God bless me, but the elephant is very like a wall." The second, feeling of the tusk, cried, "Oh, what have we here, so very round and smooth and sharp? To me 'tis mighty clear, this wonder of the elephant is very like a spear." The third approached the animal, and happening to take the squirming trunk within his hands, thus boldly up and spake, "I see," quoth he, "the elephant is very like a snake." The fourth reached out an eager hand and felt about the knee. "What most this wondrous beast is like is mighty plain," quoth he. "'Tis clear enough the elephant is very like a tree." The fifth, who chanced to touch the ear, said, "E'en the blindest man can tell what this resembles most. Deny the fact who can. This marvel of an elephant is very like a fan." The sixth no sooner had begun about the beast to grope, than seizing on a swinging tail that fell within his scope, I see, quoth he, the elephant is very like a rope. And so these men of Hindustan disputed loud and long, each in his own opinion exceeding stiff and strong, though each was partly in the right, and all were in the wrong. The moral: so oft in theologic wars, the disputants, I mean, rail on in utter ignorance of what each other means, and prate about an elephant not one of them has seen.
I think that's fairly apt, don't you, for the...
So this, another word is, as long as you are blind, you won't get what the real thing is.
Well, we're talking about something we can't see. We're talking about something we can't actually see. And we can't see...
Not what it says.
Huh?
You only have access to a certain portion of phenomenal reality.
Okay, but
that theory has to be broad enough to include other aspects.
Don't forget that those men were blind.
Yeah, well,
we're all blind.
We're all blind.
So what you're saying is that the new classicals they can see?
Well, maybe there is something that doesn't allow them to see. People believe this.
They see very well. They see all of it.
Just Kalechki said that the business leaders pay them to see, no? But okay.
Yeah.
Not to see.
The blind man and the elephant.
Oh, pardon me. I better shut that down, hadn't I? Pardon me.
It was 6 men of Hindustan.
Much boring. I just love the guy with actually animated that guy's face from an ancient photograph of him. So I could actually... I've got enough of the slides that I'll be doing next week to go through the actual Minsky laws. You want me to do that, or would you have to have a conversation now? What do you like? Conversation? Take a break? Yeah. Did anybody get a chance to read Graziani before the lecture? Okay.
I think you're a bit hard on him.